I'm David Berkowitz, the Chief Investment Officer for ValueAligned Partners, a Red Bank, New Jersey money manager and advisor for individuals and their families. Complexity tends to be the default option on Wall Street. It's used to persuade you to buy unnecessary and expensive investment products. The truth is, you only need two kinds of investments to succeed. That's right, just two. Working with the most sophisticated investors over the past 30 years, I've learned how to simplify all this needless complexity. We're faced with a financial system of seemingly limitless choices and mind-boggling complexity. Who do we take our advice from? A broker? A financial advisor? A financial planner? An insurance salesman? A bank client specialist? Who are these people anyway, and what do they do? There are more than 77,000 mutual funds worldwide, 10,000 mutual funds, and 1,400 different exchange-traded funds in the United States alone, and there are hundreds of global stock exchanges with tens of thousands of stocks to choose from. Every day we're pitched new investment instruments or products with a dizzying array of acronyms: CDO, REIT, MBS, MLP, CDS, GIC, ISA, WTF. So why do all these products with all this complexity exist in the first place? Complexity allows Wall Street to pick your pocket. In this scene, from near the beginning of the 2013 movie, The Wolf of Wall Street, the Matthew McConaughey character, Mark Hanna, there on the right, reveals Wall Street's dirty little secret to main character Jordan Belfort, played by Leonardo DiCaprio. The name of the game, McConaughey says, is moving money from the client's pocket, that's you, to your pocket, meaning Wall Street. Complexity serves the wolves of Wall Street well. Wall Street is not there to serve you. It's there to figure out ways to legally steal from you. So for your protection, let's simplify. Here's what the wolves do not want you to find out. Investing is simple. You don't need them. There are only three kinds of investments, period. First, there are fixed income investments like bonds, savings accounts, or certificates of deposits that pay you a fixed amount of dollars for a contractual period of time. A 5%, $10,000, 10-year Treasury bond pays you $500 interest per year for 10 years. And after 10 years, you get your $10,000 back. Second, there are no income investments like oil, gold, copper, and other commodities, or collectibles like art, stamps, or coins. These never pay any amount of income, no interest, no dividend. Then there is the third kind, rising income investments, which are productive businesses or shares of productive businesses, and real estate like farms or office buildings. Businesses produce profits from which dividends are paid, and real estate yields rents that can rise over time. Now listen very carefully here. Very carefully. Many reputable portfolio managers, advisors, financial planners, authors, and consultants believe you should broadly allocate your savings among stocks, bonds, cash, and commodities, and then again among many products within each category, particularly as you get older. The advice goes like this. As you get older, you need to be in safe investments like savings accounts or treasury bonds. The experts argue that this asset allocation strategy strikes an appropriate balance between your need for good returns and your need to protect your money. I couldn't disagree more. If financial independence is truly your goal, stocks aren't just part of the answer, they are the only answer. Because after 3% inflation and then taxes on top of that, stocks are the only financial asset that has any significant positive return. So after inflation and taxes, only stocks have any significant income. No income investments are purely speculative because there is no way to value gold or silver or stamps because their value is simply what somebody else will pay for them at any given time. So guess what? There are really only two kinds of investment. Bonds, deposits, and cash, fixed income, those that pay a contractual amount of interest over a specified time. And two, stocks, shares of businesses with potentially rising income and dividend, or again, what we call stocks. The problem with fixed income investments, particularly treasury bonds and cash deposits, the kind that the children of the Depression have always thought of as quote unquote safe, have become among the most dangerous investments because their interest rates are so low. And at these interest rates, they barely yield more than inflation. And after taxes, you actually lose purchasing power to inflation over time. Stocks, on the other hand, even with all the ups and downs, have not only beaten inflation, but have built great fortunes over time. So no matter what your age, stocks are the only answer. In another video, we'll show you why owning stocks is the only rational investment strategy for you and your family. Thanks for listening.